Welcome to Talk Tickers. We're your shortcut for understanding key earnings calls.
And today, we're diving into Genuine Parts Company, or GPC, their first quarter 2025 call.
Exactly. We'll pull out the main numbers management's take, basically give you the essential story.
So let's start with the top line. GPC's Q1 sales hit $5.9 billion.
Okay, $5.9 billion. How does that compare?
That's up 1.4% compared to last year.
All right, modest growth. What was behind that?
Well, mostly acquisitions, actually, and their industrial side performed a bit better.
So acquisitions were a big part. What about comparable sales, the underlying business?
Yeah, that's where it's different. Comparable sales actually dipped slightly, down 0.8%.
Okay, so the headline number is boosted by M&A.
Pretty much. Acquisitions added a good 3% to that total sales growth. Without them, it'd look, well, negative.
Got it. And wasn't there something about selling days, too?
Yes, good point. They had one less selling day this quarter compared to last year. That hurt both total and comparable sales.
All right, so a couple of headwinds for the core business there. Okay, let's talk profitability. How did the margins look?
Gross margin was a highlight, definitely. It expanded by 120 basis points year over year.
Wow, 120 basis points. That's quite a jump.
It is. They pointed to those acquisitions helping again, plus, strategic pricing and better sourcing.
So they're managing costs well at the gross level, but how did that flow down to the bottom line? Earnings per share.
That's where the story gets a bit more complicated. Adjusted EPS came in at $1.75.
$1.75. And compared to last year?
That's down 21%.
Oof, okay. A 21% drop. Why such a big decrease despite the higher gross margin?
Well, several things hit them. That fewer selling day factor, for one.
Okay.
Plus, they had lower pension income this year, and expenses like depreciation and interest were up. Oh, and foreign currency didn't help either.
Gotcha. So it's a real mixed picture then. Acquisition-fueled sales, strong gross margin, but definite pressure on the earnings.
That sums it up pretty well.
All right, let's maybe drill down into the segments. How did the global industrial business do?
Okay, industrial. Total sales there were about $2.2 billion, which was basically flat compared to last year.
Flat overall. Comps.
Comparable sales were down just a bit, less than 1%.
Okay.
But what's interesting is they saw things improve during the quarter, sequentially. Average daily sales were actually positive across January, February, and March.
Oh, that's a positive sign then. Suggests maybe things are bottoming out or turning.
Could be. They still called the market sluggish, but yeah, that sequential trend is something to watch.
Any particular bright spots or weak spots within industrial?
Yeah, they mentioned pulp and paper, aggregate and cement, and also DC and logistics were doing okay, showing growth.
Okay.
On the flip side, iron and steel, automotive manufacturing clients, and oil and gas were still under pressure.
Makes sense. And profitability in that segment, margins.
Adjusted EBITDA margin for industrial was 12.7%.
And how's that compare?
It was actually up slightly from last year, just a tick higher. So they're managing costs there pretty well despite the flat sales.
Okay, good management in a tough spot. Now let's switch over to the bigger piece for GPC, global automotive. How did that look?
Okay, automotive total sales there increased 2.5%.
Okay, positive total sales.
But again, comparable sales were down 0.8%. They said this was pretty much in line with what they expected, though, and the fewer selling days hit here, too, of course.
And any regional differences jump out in automotive? Must be varied across the globe.
Oh, absolutely. Big differences. In the U.S., total sales were up about 4%, largely thanks to acquisitions again.
But comps?
Comps in the U.S. were down around 3%. And they saw a split. Commercial customers, like garages, were growing, but retail, the DIY side, was down.
Interesting. Any color on why retail was weaker?
They mentioned non-discretionary repairs, stuff you have to fix, held up better than discretionary items. People putting off the not essential stuff, maybe.
That makes sense in this economy. What about outside the U.S.?
Canada looked strong. Good growth in both total and comparable sales. Europe saw total sales growth, but comps were flat.
Oh.
And Asia Pacific was the star, really. Double-digit growth there.
Wow, APAC really standing out. So a very diverse performance geographically. How did the overall profitability look for global automotive?
The adjusted EBIT margin for the segment actually decreased year over year.
Decreased. Okay.
Yeah.
Why was that?
Well, likely reflects those softer comparable sales, particularly in the US and Europe, combined with that selling day impact. It just put pressure on the margins.
Right. Okay, beyond the numbers, what about strategy? Anything interesting from management on that front?
Yeah, they made a point of highlighting Napa's 100-year anniversary. quite a milestone.
100 years, wow.
And tied to that, they talked about improving the customer experience, specifically rolling out their new e-commerce platform, Napa ProLink. They developed it with Google.
Napa ProLink with Google. What's the goal there?
Better search, better product info for their professional customers, mainly. Just making it easier to do business with them online. So looking back and looking forward.
Got it. How do they frame the overall economic environment? Lots of uncertainty out there.
Yeah, they definitely acknowledge that, called it dynamic and complex, mentioned tariffs, trade, geopolitics, inflation, interest rates. Those are the usual suspects.
Right.
But they stress they're focusing on what they can control: customer service, executing their plans.
And the outlook. Did they maintain their guidance despite all that uncertainty?
They did. They reaffirmed their full year 2025 guidance for both diluted and adjusted EPS.
Okay, that shows some confidence.
Yes, but with a caveat, they did acknowledge the external backdrop is, well, fluid, and that the second half could see more variability.
And crucially, what about tariffs? Did they factor those into the guidance?
No. And this is important. They specifically said the current outlook does not include any potential impact from tariffs because there's just too much uncertainty right now about what might happen.
Okay, that's a big unknown hanging out there then. Did they give any near-term guidance, say for Q2?
They did. For the second quarter, they expect adjusted earnings to be down again, roughly 15 to 20% year over year.
Similar to Q1's pressure then.
Exactly. They're basically guiding for a weaker first half, followed by a projected stronger second half to meet that full year guidance.
And the full year picture again. Sales, margins.
Full year, they expect total sales growth of 2 to 4%. Comps will vary by segment, obviously. They still expect gross margin expansion for the full year.
Even with the Q1 pressure on EPS.
Yes. Continued gross margin expansion, but also some SG&A deleverage. They're also banking on cost savings from restructuring. And capital spending and M&A plans are unchanged.
Okay. You mentioned inflation and tariffs earlier. Did they elaborate on the impact those are having right now?
On inflation, yeah. They said it gave a slight boost to the top line, the revenue.
Okay, through pricing maybe?
Right. But it had a bigger negative impact on costs, on SG&A. Things like salaries, wages, rent. Those costs are feeling inflation more. So they're managing pricing and talking to suppliers.
And the tariff situation. Beyond just excluding it from guidance.
They really emphasize how complex it is. Like, one single product could face multiple different tariff scenarios depending on sourcing and components. It's not straightforward.
Sounds like a nightmare to manage.
Exactly. They said the Q1 financial hit from any new tariffs was immaterial, basically nothing major yet, but they are watching it extremely closely, potential impact on revenue, costs, even customer demand.
So a wait-and-see approach reflected in the guidance exclusion.
Precisely. Too uncertain to model right now.
Okay, one last area before we wrap the results. Inventory and cash flow. How did those look?
Cash flow from operations and free cash flow were both down in the first quarter compared to last year.
Down. Why was that?
Primarily because they invested in inventory. Some of that was inventory coming along with those acquisitions they made.
Ah, okay. So a deliberate build, perhaps. What's the outlook for the full year on cash flow?
Still positive. Despite the Q1 dip, they expect to generate significant cash from operations and free cash flow for the full year 2025. So the Q1 drop is seen as temporary.
Okay, thanks. So let's try to pull this all together. If you're an investor listening, what's the main takeaway from this GPC call?
Well, I think it shows a company really navigating a tricky environment. You've got the benefit from acquisitions clearly helping the top line and gross margin.
Two definite positives.
Right. But you also have headwinds in the core business, the comparable sales, especially in U.S. auto retail, and there's clear pressure on near-term earnings.
Yes, the EPS drop and the Q2 guidance confirm that.
Exactly. The sequential improvement they mentioned in industrial is maybe a green shoot, something positive to watch.
Okay.
But the big overhang really is that tariff uncertainty. The fact they explicitly excluded it from guidance tells you how significant and unknown that risk is.
So manage expectations, watch the core business trends, and keep a very close eye on tariffs.
I think that's fair. Management reaffirmed the full year guidance, which signals some confidence, particularly in a stronger second half, but the risks are clearly laid out.
All right. That brings us to our favorite segment. This is not financial advice. Time for an outrageous but plausible trade idea based on this call. What have you cooked up?
Okay, thinking about those regional differences in the automotive segment.
Yeah, the U.S. weakness versus Canada and APAC strength.
Exactly. So here's a thought, again, purely speculative, not advice. Consider a paired trade. You could look at going long on an auto parts player with strong exposure to, say, Canada, or maybe that booming Asia-Pacific market they mentioned.
Okay, long where there's strength.
And pair that by going short on a primarily U.S.-focused auto parts retailer, someone more exposed to that softer retail demand and, critically, more potentially impacted by U.S. tariff uncertainty.
Playing the divergence.
Right. You're betting that the tariff situation and maybe different economic conditions will cause those regions to perform differently. Long strength, short weakness, based on factors highlighted in this call.
Interesting. Leverages the specific points GPC made.
But, and this is crucial, it's super speculative, huge risks involved. You'd need to do masses of research on the specific companies, their actual tariff exposure, market share, everything. Don't just jump in.
Absolutely. Solid disclaimer. It's a thought experiment based on the call's details. Okay, that wraps up our deep dive into the Genuine Parts Company Q1 2025 earnings call.
We've hit the key numbers, the strategy points, the outlook, and even a wild trade idea.
Hopefully, this gives you a solid understanding of where GPC stands. Think about what stood out to you, what questions you still have. Always good to keep digging. Thanks for tuning in to Talk Tickers.